this year I felt like I've been having year-end meetings and conversations, but a lot of times we're just revisiting things that we've already talked about earlier in the year. And I think sometimes that feels like, oh, did we really get much accomplished? But I think really that's a success story. A lot of times a year-end planning meeting can be revisiting where you've been and just making sure that all the loops are closed before year end. And so again, I think that that's a true sign of success.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax. Brought to you by BKD CPAs and Advisors. Everyone needs a trusted advisor. Who's yours? Now here's your host, Damien Martin.
Hello and welcome to Simply Tax. On the podcast today, we'll delve deeper into the topic of year-end tax planning, and I'm excited to share with you a phone call I had with two returning Simply Tax guests, Holly Pantzer, who we first heard from in episode 5 of the podcast, and Susan Jones of episodes 51 and 52. In our 79th episode, we took a look at the broad and complex topic of year-end tax planning, which, by the way, we received some great feedback on regarding the length of the episode, which we really appreciate. Like from Corey from Charlotte, North Carolina, who said he really enjoyed the year-end tax advisor episode. He shared that he listens on his commute and didn't think the episode was too long. In fact, it helps pass the time stuck in traffic. So thanks to Corey and everyone who shared their thoughts as well. I guess now, in addition to saying that we cut through the static of the tax world, we can also add that we make the morning commute less taxing. Now, before we hear from Holly and Susan on what they're seeing and hearing, as well as best practices for year-end tax planning for individuals, I thought it might help to share how I define year-end tax planning in the first place to help highlight its importance. Year-end tax planning is really just an intentional process of reviewing your tax and financial matters to take advantage of benefits within the tax law to help you reduce your tax burden, to review changes and updates, and evaluate and set goals. Now, as you might imagine or know from firsthand experience, it can oftentimes be challenging to cut through the static of the tax planning world. And I think Holly and Susan do a great job of sharing what they've learned from their experiences, ranging from trends in estate planning to even qualified opportunity zones. And be sure to stick around to the end of the episode, where I'll share 5 steps to help you simplify your year-end tax planning. Let's go ahead and kick things off by hearing from Holly on what's been coming up in the year-end planning discussions that she's been having.
I think the first thing that comes up is it's kind of, we hit the reset button, right? We've gotten through this busy tax filing season, and especially this year, I think clients need a summary of what's happened and to better understand, tax reform and what it meant to them. And I think a lot of our clients, they want to understand the rules of the game and where they can take advantage of opportunities for tax savings. So that's sort of the first step in these year-end planning meetings is going through all that. And then I think just overall, the real impact that you can have with year-end tax planning is collaborating with the other team members, whether it's the estate planning attorney or the financial advisor, and making sure that all the parts are moving in the right direction and in conjunction with the plan. And so that can be internally with the CFO controller, making sure if they want to take advantage of depreciation, what do they need to do there? Or on the other end of the spectrum, charitable planning, and do they have appreciated securities in place where they can take advantage of that? And, time gets away from us. So now is the time to be doing all of that.
So what would you say, kind of like, if I'm somebody in those shoes, the taxpayer that has gone through all this change, like you said, there's just a lot to be thinking about, again, had some significant changes, and maybe it's a little overwhelming. Any advice for approaching that?
Well, it is very overwhelming. I mean, I just had a meeting the other day, and obviously a really, bright person who's been extremely successful and said, I officially no longer understand taxes. And we all kind of laugh, but I think there is that sort of sense of frustration that nothing was simplified. But I think for them, it's understanding, what's the qualified business income deduction? Everyone heard about it, but what did it mean to me in my tax savings? And I've heard this question from several clients. I mean, we go through it, and then they just look at me and say, so did tax reform help me? And that's the question. And I think the biggest thing for a lot of our clients with past due entities is that they can qualify for that deduction to get their tax rate down closer to the corporate tax rate. learning a little bit too that there can be loss carry forwards included in that deduction, and how can they manage through that, and also understanding the aggregation rules. Like, if they have several companies, did it make sense to aggregate them, or was it better to leave more flexibility and not make that irrevocable election this year, and put all those companies together in that calculation for the qualified business income deduction? So that's where we've done some strategizing.
Yeah, a lot of moving pieces, interesting changes. What I'm hearing you say is it comes down to kind of the how it applied to your situation and understanding what it meant for you. So I don't know, Susan, I guess what are some best practices that you'd say or you've seen implemented with regards to year-end tax planning?
Well, Damien, I think Holly, really mentioned one of the biggest points, and that's just making sure that you have your entire team of advisors kind of in the loop and working together. I think sometimes we see where a client works with one advisor, but then that it doesn't get communicated to the entire team, and so there's a missed opportunity, or even an opportunity that isn't quite as good, or has a surprising effect, which is never good at tax time, particularly in April. And then I think really just making sure that, you're either meeting in person with your advisors, or having a phone call, or, somehow having some kind of communication where you're, able to communicate about, a lot of different things that are going on. Email's fantastic, but, sometimes I see where if we're trying to do some year-end planning or a projection, if you ask, too pointed of questions, sometimes you lose out on the bigger picture, or something that, maybe a client has had a life change. They've had a child or a grandchild, maybe had a change in marital status, something like that, that it, again, if you're just really focused on what happened last year and asking detailed questions about what the income looks like this year versus last year, you might miss out on some of those, larger kind of, again, life events that can really impact planning. And then I think once you kind of move through that and you've had those discussions, then being able to formulate a plan and move forward, that really includes leaving yourself enough runway that, to the extent you're doing year end planning, that you have enough time to actually accomplish something by year end. So I think that's why it's so important to start having these conversations now. I always think of Thanksgiving as really the time that year end planning should be happening. So we're certainly in that season right now.
Good advice and kind of, yeah, getting all the pieces together and kind of thinking about, even if it's not in person, the phone call or, gosh, actually the other day I had a video call and that actually, I think kind of opens up and makes you think of some of the things that maybe aren't top of mind. Like you said, some marital changes and things like that can come into play and have such a big impact.
Yeah, really, again, I think sometimes we can get, or, when I say we, I mean advisors, a little bit too into the weeds. And so I think it's really important for everyone to be thinking about, not just what happened this year, but what's going to happen next year, the year after that. Again, some of those larger issues as well.
Yeah, and I guess I'll just we'll kind of open this up to both of you and kind of see what are some of the biggest challenges that we've been facing, I guess, with some of this year-end planning that we're doing and that you're doing with respect to the tax reform changes and how it's affecting things.
Well, I think a lot of what we're seeing is this. I go back to the qualified business income deduction and understanding what it is, and then the aggregation rules that go along with that. And so, does it make sense for me to aggregate my companies because I need to utilize different factors to get to the right calculation and get the best deduction that I can? Does it make sense to take bonus depreciation, because then that could reduce my overall taxable income? And then, am I missing out on as much of that qualified business income, that 20% deduction that I could get? So I see some balancing there. Do you see that, Susan, or is that an area in your practice?
I do. I do. And I think that's almost more important this year, Holly, now that we've kind of been through an entire year of it. We've seen how it works, both, from the good when it works out just how we thought it would. And then I think sometimes some of the surprises. You think that you're going to get the full 20% deduction, but then maybe there's a taxable income limitation. Or, when you really dig into those aggregation rules, maybe, you don't quite get there. And so I think for 2019, that provides a lot of opportunities because, again, we've kind of now been through a cycle. In a lot of cases, we were able to, kind of put into place some action steps in order to really maximize the deduction this year or next year. But it has, I think, again, it's added some complexity to year-end planning for sure.
Another little quirky thing I felt like that came up a fair amount through the 2018 filings, is that if someone had large capital gains, so in essence, their total taxable income was a capital gain, even though they had operating businesses, within their tax return, within their income and expenses, you don't get that qualified business income deduction. So, that's just managing the understanding of the tax law. And so overall, it's still a good answer. You're in a low tax bracket, but that feeling of, wait a minute, but I didn't get that 20% deduction.
Yeah, that's really true, Holly. I would say that's one of the biggest surprises in tax reform that I've seen. And I think, the fact that that 20% deduction doesn't carry forward in any manner makes it even more, important to at least understand, kind of what's happening. And, I think your point is good too, though. If you end up in a 20% overall tax bracket, that's still a great answer in a lot of cases, but at least expecting that and being able to plan for that and then decide if it is something that, can be even sharpened further or if that's the best answer. I think, again, this is the time to be thinking about that as opposed to March or April.
Yeah, and you make a good point there that the qualified business income doesn't carry forward, but the loss does, right?
Right.
So it's one-sided, right?
Right.
So
Very one-sided. Yeah.
yeah. So maybe if you're carrying forward that loss carry forward, but then you also have appreciated securities in your total personal portfolio, maybe you do want to recognize capital gains when you're
Right.
not going to get the QBI deduction.
And, I think another thing that, I think we were really proactive last year, and so we didn't get caught. But, for a lot of taxpayers who maybe have an operating business that generally throws off large losses, or Holly, as you mentioned, because of all of the accelerated, depreciation options that we have now, a lot of times, client thinks, oh, I made $1 million, but I lost $1.2 million, so I don't have taxable income, so we can all kind of, move forward and nothing needs to be done. Whereas now, because of the limitations on net operating losses, as well as that limitation on the excess business losses, that's really not nearly as clear as it used to be. And so I think that's just a really new way of thinking, even for us as advisors, that's a situation where you really could have a large loss, but still end up with taxable income and have a tax liability.
Yes, that is true. And then there's also, that brings about the balancing act between, okay, I have a trader business, but am I passive or non-passive? So if you're passive, are you just sort of banking away those passive losses, as opposed to if it's, well, I qualify as non-passive, I'm actively involved in this business, but then you get hung up on that excess business loss, which of course you get to carry it forward, but balancing those two different types of loss carry forwards and what's going to be more meaningful for you.
Right. Yeah. And, and that's a good point too, Holly, because again, when we talk about looking at, a multi-year approach and kind of questioning things and not, assuming that everything's the same this year as it was last year. I mean, that's certainly looking at material participation. You can materially participate in an activity that you weren't a material participant the year before. So I think that's one of those questions that we just also have to make sure that we're talking with clients about, and that, to the extent clients have had a change in their level of activity, that's something they should realize that their advisors need to know as well.
That's a great point. And a good reminder probably as well that, yeah, we have the biggest tax change in 30 plus years, but, we're kind of layering onto the existing tax law, which is complex in its own right. And the passive activity loss rules are definitely no exception to that, right? And it's a lot of kind of getting to know the facts and circumstances of a situation, and it kind of varies by different taxpayers. So all great points and things that can create surprises, I would think too, that if you're not careful with the math, right? And you got to actually run the numbers to figure out how it works. I guess maybe one of those areas I know there's particular interest in things like the limitation on itemized deductions and kind of how that changed that landscape with the limitation on the overall SALT deduction to the $10,000 cap to some of the other limitations. Have you seen that come into conversations and maybe again been surprising in some way?
I was just thinking about one of the biggest changes in year-end planning is what we're maybe not doing, which is as much of the making sure that we're timing the payment of state income taxes, particularly if a client has a large income event and we're trying to avoid the alternative minimum tax. And so, I have wondered if some clients are still wondering why we're not talking about that as much, or if they've, really, kind of realized the extent of that limitation. But, certainly that's one of the biggest changes that I see in kind of the shift in year-end planning.
Yeah, it's a good point. It's sort of taking that pressure point off of the race to the December 31 to get that state tax payment made. And you're right that people are sort of like, what's changed? But it just doesn't matter for the next 6 years or so. And I think when you look at someone's return, basically what we're saying is do you have an interest expense deduction or a charitable gift? And if not, then standard deductions probably going to be better for you. And so I have seen clients that are balancing their charitable giving. I mean, they may be very charitable, but maybe one year they give away, $500,000, and then the next year it's a smaller amount to balance that with the itemized deductions. And then, of course, some people don't need a mortgage, but maybe it's one of the last tax deductions left that you can take advantage of.
Holly, that's so interesting that you said that, because Damien and I had a presentation where we were speaking to a group of high net worth taxpayers, and we discussed the standard deduction. And Damien and I were talking about the fact that we have taxpayers who are extremely high net worth, who have a large amount of income, but simply don't have the amount of itemized deductions, and so they are taking the standard deduction. And I have a lot of clients who like you said, they've paid off their mortgage. They don't need a mortgage. They're of course limited to the $10,000 cap on their state and local tax payments. And in a lot of cases, they funded either a private foundation or a donor advised fund. And that's really where they're making a lot of their charitable contributions. And so at the end of the day, they just really don't have enough itemized deductions in order to be able to use it. So that with the increased standard deduction, they end up, again, taxpayers you would never think would be using the standard deduction are in fact using the standard deduction.
It's definitely changed the environment, right?
It does. It changes the conversation. I mean, you're right. Well, typically with our high net worth clients, I mean, we would be going through the itemized deductions and all the various deductions they qualified for. And of course, generally speaking, they didn't get the state and local income tax deduction if they were falling into the alternative minimum tax. So it's not like that was a huge loss for them. But I feel like as they sit there looking at the projections now, they're like, well, I've lost everything, right? And there's just nothing on this page for me to strategize with. And Susan makes a good point. They've already pre-funded that donor advised fund or the private foundation. I mean, they could be extremely charitable, but it's not a tax deduction in the current space that they're in.
Susan, yeah, we were talking again in part about some of the changes, in part because of the changes to the itemized deductions, but just the overall charitable giving landscape and kind of what we're seeing and hearing. So I don't know, maybe you could talk to that a little bit, and in your practice, what you're seeing taxpayers do, and some of the ideas maybe that you can implement when it comes to a philanthropic plan.
Well, I think when tax reform was first introduced, there was a lot of concern, I think, even in the nonprofit community about what that would do to the level of charitable giving. And I think, charitable giving has always been one of those. I mean, a lot of individuals are really, really charitably inclined, but then also, interested in maximizing the deduction for those gifts. And that's, of course, one of those deductions that, individuals usually do have a large amount of discretion over when they're made. And so unlike things like maybe the payment of taxes or paying your mortgage, you can kind of, fluctuate that from year to year. So one of the things, that we saw, kind of really beginning in 2017 before we saw the rate decrease, but still can be a great idea for taxpayers who maybe are going to be in that range where they're close to the standard deduction. And so they're not going to get maybe the full benefit of all of their charitable deductions. Doing things like bunching charitable deductions either into one year, or, that can sometimes, though, not feel comfortable to a client who is used to making annual gifts to favorite charities. So that's a time that maybe a donor advised fund does make a lot of sense. And those are just set up through a financial institution. You make a gift, you're allowed a charitable contribution for that full amount of the gift when you make it to the donor advised fund. But then you can advise the fund over as many years as you'd like to actually make the payments to the charities of your choice. And so it's kind of really the best of all worlds. So you get your immediate deduction, but then you can kind of control the eventual distribution of those funds so that it looks more like your annual giving that, maybe you're doing now. For individuals who are considering a larger gift or would maybe like to keep a little bit more control over how funds are invested and kind of the operation of those funds, a private foundation can also be a really good choice. And there are some lower adjusted gross income limitations with a private foundation, but again, that can still be a really good choice and allows, again, that immediate income tax deduction for the initial contribution to the foundation, but then the ability to then distribute those funds over a number of years to the ultimate charitable beneficiary. I also think this is low interest rate environment, and so something like a charitable lead trust for individuals who again, are charitably inclined and also are maybe looking at estate planning options and thinking that could be a really good way to leave assets to a charity for a term of years or for a life term, and then eventually have those assets distributed to family members.
Those are nice too because they get the benefit of seeing the charity have some enjoyment of their funds while they're living, knowing that they've also saved estate taxes.
Yeah. Even though low interest rate environment isn't necessarily as good for charitable remainder trusts because the value of that charitable contribution deduction does get reduced a bit. But that can also be a really good option for clients who have a charitable intent but maybe want to keep an income stream, or for clients who have maybe a large concentration of stock and they want to diversify and again keep an income stream, but then have an ultimate charitable intent for those assets. So I am still seeing a fair amount of charitable remainder trusts. Is that something you're seeing, Holly, too?
I'm probably seeing more charitable lead trusts right now, but I do agree with you with that large concentration of stock. It's an excellent planning tool. And going back to what you were talking about before, too, the opportunity to take advantage, and this has nothing to do with tax reform, but just charitable giving in general, and it's tried and true, take advantage of giving away those appreciated securities so that you're not paying the capital gains tax, you're getting that deduction on your income tax return at the fair market value. I have a client going through that right now, trying to manage, front loading, funding their private foundation with appreciated securities while they're in the high income years. And just knowing that that deduction, when you're giving appreciated securities to a private foundation, is going to be limited to 20% of their AGI. So we're managing that out here over the next 5 to 6 years to maximize the value that they can get into that foundation and let it grow for those later years, when they'll probably be doing more of their charitable gifting from the foundation.
Yeah, and Holly, that's a great point because a lot of times when we talk about more, complex giving strategies, it's easy to forget, the almost one of the best strategies of all, which is donating appreciated, securities and being able to take, as long as they're long term, the fair market value is the deduction and not, recognize that embedded gain. So certainly don't want to miss out on that.
I guess what I'm kind of getting the sense of is, kind of managing some of the buckets. And Susan, you touched on this earlier with the intersection of maybe the charitable giving, the philanthropic plan, and the estate plan, and maybe a need to revisit that, particularly after these changes that we had to the tax law. I don't know, maybe Susan, you want to kind of start, and Holly chime in on kind of what you're seeing and hearing in from, I guess, the estate planning perspective.
Well, one of the great benefits to the tax reform legislation was that, basically the doubling of the estate tax exemption. And so for 2019, we're at $11.4 million and we're at what, 11.6585? What is it for 2020?
11.58. So yeah, you're right. Yeah.
Yeah. But, so that's really provided a lot of opportunities for clients to do additional planning. When we were stuck at that, 5 point, it was supposed to be 6 million. A lot of clients had already really made significant gifts at the end of 2012 with the fear that the estate tax exemption would decrease. And so we're really working with kind of smaller buckets each year. And so, obviously that that increase really provided a lot of opportunities. Also, the IRS issued some guidance, just really, giving individuals some peace of mind that if they did go ahead and make, these significant gifts and use much or all of their exemption amount, that should the exemption, should we see the sunset and the exemption revert to, pre-tax reform levels, that there wouldn't be a clawback of that, so that that amount wouldn't then be taxable. So I think this year I've seen a lot of clients actually move forward with estate planning, a lot of times using kind of the tried and true methods that we've been using. So making gifts of assets that can be leveraged with discounts to irrevocable trusts, be making even, part gift, part sale. That's certainly something that we're still seeing quite a bit of.
I would agree with Susan. Those are exactly the kinds of things we're seeing. Definitely an increased interest in charitable lead trusts. And like you said, the tried and true, I mean, grats, even though they're not using that exemption, they're still a very popular tool to complement these bigger gifts that are using the exemption.
Yeah. And, grats, I think, knock on wood, this has been, I think, a really good time for those, just because, again, we have the low interest rate environment, but also in a lot of cases, really nice market returns. And so, that kind of that benefit, as long as you can have appreciation that exceeds that IRS prescribed interest rate, even if it's a zero grat. So like Holly says, you actually don't use any exemption, that can be a great planning tool.
So are you seeing and having a lot of these conversations about making some changes and taking action? Or is it still kind of a little bit of okay, we got the anti-clawback guidance, but I'm still maybe not ready to pull the trigger yet?
I've seen a lot of clients moving forward. And another thing that I've seen more this year than ever before, and also that I've been having a lot of conversations about, is the spousal access lifetime trust, the SLAT. And I really hadn't seen those much, to be honest, pre 2018, just because, to the extent that you're setting up an irrevocable trust and using exemption, both in a lot of cases, your estate tax exemption and your generation skipping tax exemption, the best use of those exemptions is not typically your spouse, because you have the unlimited marital deduction. But what I've seen, though, is a lot of clients who may be giving away, the full $11.4 million per person, doesn't feel maybe comfortable with the amount that they have left. But if they can give it in a way that their spouse would be able to access those funds if they needed to, that makes it much more palatable. And so I have seen a number of clients actually move forward using that mechanism, which I think, for in that situation, really can be a good way to use your exemption without, going poor yourself.
I know another kind of related topic, and kind of, again, kind of thinking about some of the different avenues is, well, what if perhaps you think that you're going to be under at least the current double, greater than $22 million lifetime exemption for a family unit? Are you kind of seeing anybody take action in that way? And then maybe are there some things that you can do to maybe preserve some tax basis if you anticipate that?
Yeah, I think that's a really good point. And that you do, I mean, that is 22 million. I mean, there are a lot of people that are below the 22 million. And, should you just hold on and get that step up in basis? But I wouldn't say that's the predominant thought. I mean, I think everyone knows here in the next 6 years, it's going to go back down, right, to the 5.6 million. And so I don't hear as much of that discussion. Do you, Susan?
No, I haven't. I will say that I've seen a few cases where a parent who, they've actually made gifts, upward gifts to a parent, with the idea that, low basis assets, that eventually they'll have a step up in basis. And so I have seen a few situations like that, but not a lot, not a lot. And I think we're all optimistic, right? So I've seen a lot more, planning with the idea that wealth will grow and it'll be closer to that amount, or I guess the pessimistic view that the exemption will go down, but even then that, we'll be closer to that amount.
Yeah, it's funny too, on the opposite end of the spectrum. I've recently been going through a conversation with a family about possible disclaimers and like, oh, it'd be better if I, pass it down to that next generation. And then they're like, oh, but then, oh no, they'll have, lower basis in the long run and have capital gains to worry about. It'll grow it and they'll be in their state and they'll have the estate tax and all this. And I'm thinking, who knows? Who knows what the future holds, if there will even be an estate tax. So
that is true. That is true. And that's one thing too. I mean, with all the talk about the different tax proposals that we could see eventually, even things like a annual wealth tax. I mean, we really could see a big shift in the estate tax environment in the next several years.
yes. And while that sounds unbelievable to me as I sit here today, I also didn't think I was going to see the tax reform we saw, on December 22nd of 2017 happen.
Right.
Yeah. So,
Right.
It's a good point. And kind of having some of that flexibility and just thinking about all the things that could take place. I mean, it's impossible to know. So it kind of seems like having again, to take your words, Susan, multi-year approach, creating flexibility, but then also taking advantage of windows of opportunity that we do have. Like, we know what the lifetime exemption amount is now. We know that even if it goes down, there won't be clawback to worry about. So there definitely seems to be some things that we do know, despite some of the headwinds or uncertainty or whatever you might have. So gosh, there's a lot to think about, right?
there really is.
Yeah, and the one thing that we haven't really touched on too, I mean, even in terms of income tax planning, the fact that we could be, this isn't something that it's hard when you're asked to write a check to pay taxes to think about that we might be in the lowest income tax rate environment that we're going to see for quite some time. And so that traditional thought process of, defer, 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 to the extent that right now at 37% for ordinary income and for 20% for capital gains, that might be the lowest that we see, for quite some time. Maybe that deferral isn't always the answer, which again, that just feels very counterintuitive, but
it does, Susan. And that's a good point, because obviously with the bonus depreciation still being at 100%, but going down, there's this ebb and flow of, should I take the 100% of the bonus depreciation? Oh, but I'm in one of the lowest income tax rate environments I may see for a while. So I think it can be frustrating for people at times to figure out which direction to take.
I know. If only we had that crystal ball. Do you have yours ready, Holly?
Right.
That would be nice to kind of have that figured out. But maybe that's also, it gets back to that point talking about earlier of kind of having that holistic conversation, bringing all the advisors in, talking about all the different things that maybe are non-tax related that impact the tax plan, and really making it sometimes beyond the tax and succession planning for the future of the family, wealth transfers, all these sorts of things that have direct tax impacts, obviously, but can also accomplish other goals as well. So I feel like it's kind of getting back to that whole holistic concept. I don't know. I guess, are there anything that we haven't covered, or maybe some closing thoughts on just the year-end planning and the things that you're seeing? So maybe Holly, we'll start with you.
Well, I was just going to add on to what you just said, Damien. I mean, going back to that and the holistic planning, and what Susan talked about earlier is having all the advisors at the table together, because you're right. While you and I are different people and may see things from a different perspective, having an estate planning attorney or a financial planner to offset, my tax mind at the table, I think helps in the best way possible, because everybody has a little bit different perspective. And when we can all talk through it in a dynamic way, I think we bring the best answers.
Yeah, I agree wholeheartedly with Holly. I mean, I don't even know if I can add anything to that, Holly. You said it so well. But I think that really is the goal of year-end planning, is to make sure that we're having those meaningful discussions. So again, not just a banter on email, but actually having a meaningful discussion and thinking through what happened, during 2019, the expectations for 2020, and really just talking through different issues. It could be clearly tax related, maybe not tax related, but just making sure that really we do get that big picture. And then again, in enough time that if there are some action items that need to happen before year end, that there is just that runway that I mentioned earlier.
That's a good point too. You're right. It's nothing worse than having a great idea and not having the time to implement it.
I'm enjoying sitting here listening to you too, because there's just, you kind of run through this mental checklist almost of things to think about. And it really just depends on everybody's situation, which is again, I think Holly, you said this, it can be sometimes frustrating, But, that's where the importance of having these conversations and going through this process and being intentional about the planning versus kind of being reactive. You can kind of taking that proactive approach. So, yeah, I don't know. What do you guys think? Anything else to cover or to mention?
Damien, the one thing we didn't talk about, I realized, was qualified opportunity zones.
That's a great point. Yeah.
And I bring it up only because, the 12/31 of 19 is the last time, it's really the cutoff in order to invest in a qualified opportunity zone and receive the maximum exclusion amount. And so, just for anyone who's had a significant capital gain, it can be kind of a complex. Certainly, setting up a fund and doing that is very complex. But even, it takes some time to find an investment and to really think that through. So that's something that for anyone who's had a significant capital gain who is interested in that, certainly the earlier to talk to your advisors and think that through, the better.
I guess two things there. One, we'll include a link in the show notes of the episode to some of the conversations we've had with Derek Smith, who I know both of you know well, and I always feel like every time I have a conversation with him about qualified opportunity zones, I walk out with some other planning idea or thought about it that I hadn't even thought of. But also kind of again going back to this, bringing everybody around the table. The qualified opportunity zone opportunity, I guess, if you will. It has a financial component. You got to has to be a good investment. There has to be gain there to ultimately get this permanent exclusion that everybody's so excited about. It has to, model the tax piece. You've got to think about cash flow. You've got to think about just all these different things that come into play. So it's kind of like this perfect intersection and maybe example of, the sorts of things that you can cover in a year-end planning type conversation.
Right. That's absolutely true. Because like you said, I mean, that's one of those things where, you really have to think through what the investment return looks like, factoring in a potential deferral or exclusion of gain. And then also think about, again, if the tax rates are going to change and you're, plan to do the 10-year hold, what that looks like too. So that really is a good example of all the things we just talked about kind of coming together.
Yeah, I would agree. And I think that's where, from a tax perspective, we provide that side of things where we can talk through the rules and the requirements. But, we had a QOZ, a qualified opportunity zone here in Annapolis development, and it ended up not coming together. And it's been going on now for most of the year. And I think people thought it was going to be a viable opportunity to place their funds. So I think that's where the investment advisor plays such a critical role. Because you can save all the taxes in the world, but if it's not the right investment, it's not going to work out.
Oh, great point, Susan. Thank you for bringing that up.
Yeah, that one's particularly time sensitive.
I guess last question before I let you get back to your busy days, because I appreciate you taking the time to carve this out and just have this conversation in the first place, because I feel like everybody, and I know the two of you as well, just looking at your calendars, have a lot going on right now. Definitely kind of ramped up real fast here from a tax perspective. But I don't know, any recurring questions, I guess. What's the biggest question that you're getting right now? Something we've covered or otherwise. Susan, what would you say? The biggest question that you're getting from either clients, attorneys you talk to, anybody that you're going into these conversations with?
I don't know if it's a question, Damien. I would say the biggest thing that's going on for me right now is trying to finish up estate planning before year end, and kind of, I would call it stage 2 estate planning, where people who have maybe made some gifts in the past, but now they're really ready to move forward with large gifts to irrevocable trusts of, sometimes stocks, sometimes closely held business interests, and just everything that goes along with that. So trying to arrange the valuations, trying to make sure everything gets signed, properly before year end, and all of those types of things. So again, not a question, but I would say that's the biggest thing I've seen in the past 2 to 3 weeks, is just really a push on the estate planning side.
Well, I would concur with Susan, and I just think everything going on in the world today and the media and politics has just heightened that interest in the estate planning, or maybe heightened the anxiety in getting that taken care of. So that is definitely what has become the focus here as we near the end of the year.
So keep your valuation expert on speed dial, because
That's right.
You might need them here. Is that what I'm hearing, right? Before the end of the year.
Right, exactly. And that's really something too, where thinking through multi-year gifts. So if, again, I talked earlier about, the power of, using discounts to make gifts of closely held stock and things like that. But a lot of times that really does take thinking through, that gift over a multi-year period in order to really capture, the maximum discounts and really, minimize that overall transfer.
I don't know about you, but I personally had some great takeaways from Holly and Susan. And for the sake of Corey and any of our other listeners that might be driving right now, I thought I'd recap them in 5 steps to help you simplify your year-end tax planning. Step 1. Review your current tax situation and take note of the following key items for your 2018 individual income tax return: your filing status, adjusted gross income, whether you took the standard deduction or itemized, exemptions taken, taxable income, and whether or not you are subject to the alternative minimum tax or AMT. Step 2. Consider changes to your tax situation. These might include changes to your marital status, new investments or business ventures, or a change in state residency. Step 3. Assess the timing of income and deductions. Now, this applies to both business and non-business deductions and requires special consideration and care after the tax law changes of recent tax reform, so consult your tax advisor. Step 4 is revisit your estate plan. As Holly and Susan discussed, the increased lifetime exemption provides a large opportunity to implement additional estate tax planning strategies. However, the additional opportunity is only available for a limited time under the current tax law due to its sunset in 2025. The good news is, though, that we know from recently finalized guidance from Treasury and IRS that they won't claw back the additional lifetime exemption amount that's used over the increased amount. So, now is a good time to have these conversations. But keep in mind, your strategy depends on whether or not you face a potential estate tax liability. And step 5 is to consider the effect of other tax developments, such as opportunity zones, the potential impact of the upcoming election, and state and local tax developments. If you'd like to know more about these steps, drop us an email at simplytax@bkd.com and we'll send you a slide deck that explores these steps further. I'd like to thank Holly and Susan for sharing their insights on the podcast today. You can learn more about our guests and get additional resources in the show notes of this episode, which are available at bkd.com/simplytax. And while you're out there, you can also learn more about me and find links to all of our episodes and even our Simply Tax videos. And be sure to check me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.